Good morning and welcome back to Market Day Report. I'm Chris Swift, sitting in for Scott Shellady this morning. Grain markets have not been very friendly to our farmers. Let's take a look and see if they have improved any since Marlin walked off here. He was not showing too many good numbers, and unfortunately still not. Got the December corn, 478 3/4, down 5 1/4. March now well under $5 at 493 1/2, down 4 1/2. The rest of the month's hanging in right at just above $5. Our soybean market had been a little bit lower as well, and is not quite as low now. With January down 6 3/4, 1307 3/4. Out to the May contract, 1334, down a nickel. In our wheat market, we'll start off with Chicago wheat this morning, and Chicago wheat had been softer and still is, a little off the lows, but not much. Dece wheat down 7 3/4, 572 3/4. March down 8, 599 1/2, and July new crop down 7, 630 1/2. Kansas City hard red winter wheat down 11 on the December, 652 even. March down a dime at 661 3/4. And out to our cotton market. Let's spring wheat. There we go. Minneapolis spring wheat. Take a look at it real quick. Down 6 on the December, 722 1/4. March down 6 3/4 at 740 1/2. Now our cotton market. Cotton had been the shining star this morning, a little firmer. Still is up now a penny on the December at 83.98. March up 95 at 85.63, and the July contract up 73 at 86.58. I've got my guest Riley Schwieger on the phone this morning. And Riley, I certainly do appreciate you taking the time to be with us. We know that the dry weather has been a great asset to our farmers harvesting. Now we got a little bit of rain coming in. Is that going to hamper too much of the harvest?
Yeah, I think there's a good chance that rain will slow things down a little bit. And here on the energy side, especially as it comes with supply and diesel supply and getting diesel to the terminals so those farmers can get access to it, that really helps out. Specifically in the diesel market, if you were in the Midwest region, you saw basis levels skyrocket at the end of last week. We actually saw basis levels for diesel climb over $1 over NYMEX diesel futures. So that put a lot of pressure on those cash prices. So maybe those farmers who didn't contract or lock in those values, those prices that they were paying were definitely not favorable. But fortunately, we've seen a lot of that come back down. I think we've got basis levels in single digits this week. So finding some relief there. Other drivers in the energy space, we had the EIA report today that did show crude stocks, or showed a surprise build in crude stocks. We saw stocks up 1.3 million barrels there. And then really important, our Cushing stocks, the delivery point for WTI also rose. Those inventories are near operational minimums where they wouldn't be able to pull product out if we saw further declines, kind of where we're at right now. We're kind of continuing to monitor the situation in the Middle East. Obviously, with no escalation over the weekend, we saw maybe a little bit more risk-off pressure, pressuring prices lower today. I think crude's off nearly $5 this week. But we are looking to battle a little bit off the lows here. So that's positive. And then on the gasoline side, obviously, pump prices remain pretty high, but just looking at some of the AAA averages, we're seeing $3.54 at the pump today versus $3.85 just a month ago. So plenty of relief there. Obviously, we're well out of driving season now. Demand looks to be steady, still not probably as high as some would think it would be, but not enough to sound the alarms there. The diesel demand is the one we're keeping an eye on, an 8% drop last week. Obviously, if we see diesel demand drop at an alarming rate, that's going to set off some of those economic indicators that could signal recession. So looking ahead here, again, very volatile situation in the Middle East. Anything that spills outside of the current area could put energy infrastructure at risk and could provide, markets to buy back up to where they were last week. And then just looking at some of the economic data rolling out, Eurozone data looked pretty bearish, some higher than expected contractions last week. I'll be monitoring whether that's a trend that we see here in the U.S. As a downside pressure on energy markets. So it's kind of what we're seeing today.
Fantastic. So last week I noticed, I think it was on Friday, Department of Energy said they were coming back into the market to try to refill some of those SPRs. Have you heard about them coming in yet? I haven't seen really any kind of market movement that would suggest they are.
Yeah, they did announce that they intend to buy, I think it was 6 more million barrels. I anticipate that they will continue to be active, especially if we see more downside in their market. Their original targets were that $67 to $72 range, which we're very far away from now, but I think 79 was their most recent purchase level. So Further downside, I expect them to come in because, yeah, those SPR inventories are very, very low, and that's part of what relieved some of this price pressure last year, and that's just not a card on the table this year. So we'll see if they continue to be a buyer in this market.
Absolutely. Riley, I certainly do appreciate you taking the time to be on the show with us this morning. It's Riley Schwieger with CHS Commodities. I'm Chris Swift. We're going to take a short commercial break, and we're going to be right back and talk cattle. Stay with us.